let's jump right into this explainer. You probably already know your way around a basic balance sheet, but today we're actually going to move beyond the raw data to see how financial statements tell a living, breathing story about a company's health. We're going to break down the fundamental reports of business finance using a real-world example so you can really understand what's going on under the hood of any business. To make all this super tangible, we're going to look at Tealicious, which is a fictional, family-run black tea company that's just successfully closed out its financial year. Now, the documents they've prepared to summarize their activities and financial health are what we call financial statements. Investors and lenders literally rely on these exact reports to figure out if the patient, in this case the business, is thriving or just barely scraping by. So here's our roadmap for today. First, we'll meet the big three. Then we'll look at the balance sheet snapshot, followed by the income statement video. After that, we'll tackle cash versus accrual accounting, dive into the cash flow statement, and finally, bring it all together. All right, Section 1, meet the big three, the core reports of financial health. If you really want to understand the financial health of Tealicious, or honestly, any business at all, there are three main statements you've absolutely got to know. We're talking about the balance sheet, the income statement, and the cash flow statement. Together, these three documents make up the holy trinity of accounting. If you're looking to make a smart investment, or you just want to make sure a company can actually afford its own tea leaves, these are the exact documents you ask for. Moving right along to Section 2, the balance sheet snapshot, a single point in time. Think of the balance sheet as literally freezing time. Imagine taking a photograph exactly on December 31st at midnight. On one side of the ledger, we have assets. This is simply everything Tealicious owns: the raw tea inventory, the brewing equipment, the actual cash sitting in the bank. On the other side, we have liabilities and equity, which represents everything the business owes. It owes liabilities to third parties, like suppliers, the tax office, employees. But crucially, it also owes equity back to the owners of the business. That equity includes the original cash they injected to start the company, plus all the accumulated profits they've strategically held onto over the years. If we collapse that debt side down and look just at the owner's piece of the pie, we get $129.5 million. That's Tealicious's total equity. And why does that matter to you? Well, because it represents the theoretical baseline value of the business to its owners. If Tealicious suddenly sold off every single asset it owns and paid off every single debt, this $129.5 million is the exact amount of cash the family would walk away with. The whole reason this works is because of the golden rule of accounting. Assets must always equal liabilities plus equity. Put in plain, everyday English, the stuff a business owns is perfectly equal to the stuff a business owes. It's basically impossible to have an asset without it being funded either by debt, a liability, or by the owners, which is equity. And that brings us to $169 million. This beautifully balanced number is the total for the assets and the exact same total for the combined liabilities and equity for Tealicious. Seriously, if a balance sheet doesn't balance to the exact cent, somebody made a mistake. It's a mathematical certainty. Section 3, the income statement video, covering a period of time. Okay, so if the balance sheet is a static photograph, the income statement is a video, or maybe more like a boomerang that covers a full stretch of time, like the entire 12 months ending December 31st. Over that year, Tealicious brought in a top line of $255 million in revenue just from selling their black tea. But of course, to make that tea and run the company, they incurred $248 million in expenses. Those are all the direct and indirect costs of actually keeping the lights on and running the day-to-day operations. When you subtract those $248 million in expenses from the revenue, boom, you're left with $7 million in net profit. This answers the absolute most burning question any investor has. Did this business actually make any money over the last year? Section 4, cash versus accrual accounting, the narrative pivot. Now, here's where things get a bit tricky, so stick with me. Seeing $7 million in profit doesn't mean Tealicious actually has $7 million sitting in the bank right now. Think about this. What if they make a massive tea sale to a huge grocery chain, but the grocer doesn't actually pay the invoice until next year? Under a simple cash system, your revenue looks terrible this year and amazing next year, even though the actual work happened right now. That exposes a massive limitation of just relying on the income statement if we don't have the cash in hand.
To get around that exact headache, larger businesses like Tealicious use something called accrual accounting rather than cash accounting. Cash accounting, which is what really small businesses often use, just records things when the cash physically moves in or out. Accrual accounting, on the other hand, recognizes revenue when it's actively earned and expenses when they're incurred, completely regardless of when the cash actually changes hands. It tracks the true economic substance of the transaction, giving us a much more accurate, smoothed-out picture of performance.
Which brings us to Section 5, the cash flow statement, tracking the actual cash. So if revenue doesn't equal cash coming in and expenses don't equal cash going out, where do we actually find out what happened to our money? Well, right here. The cash flow statement breaks down exactly how cash moves into 3 distinct buckets. First up, operating activities. This is the actual cash generated or spent just from doing regular business, like selling tea. Second, investing activities. This tracks cash moving outside core operations. Think buying a new tea roasting machine or selling an old delivery truck. And third, financing activities. This is all about funding the business, tracking cash from bank loans or cash paid out to the owners. And that leads right to the grand finale of the statement, the bottom line reconciliation. We start with our opening cash balance, which is $11 million, pulled straight from last year's balance sheet snapshot. We add up all the net cash movements from those operating, investing, and financing activities, which gave us a net increase of $1 million. And logically, that leaves us with a closing cash balance of $12 million. It ties everything together perfectly, tracking every single dollar.
Section 6. Bringing it all together. The complete picture.
Look, these 3 statements aren't just isolated pieces of paper. They are a tightly connected ecosystem. You absolutely need the balance sheet snapshot to know exactly what is owned versus owed at a specific moment in time. You need the income statement video to see the actual profit generated over the whole year. And you for sure need the cash flow statement to track the physical reality of money moving in and out, just to make sure you can keep the lights on. Working together, they give you the absolute truth about a company's financial standing. To wrap up this explainer, I want to leave you with a real-world scenario to chew on. If you are evaluating a business during a severe economic downturn or some sudden market shock, which of these 3 statements do you think is the absolute most vital for its immediate, day-to-day survival? Is it the massive total assets on the balance sheet, the impressive profit on the income statement, or the actual physical cash on hand flowing through the cash flow statement? Think about how you'd apply these tools in a real crisis, because honestly, knowledge is power, and knowing how to read these reports gives you a tremendous edge. Thanks for hanging out with me for this, and I hope you're walking away feeling fully empowered to decode the financial health of any business out there.